Unveiling the true culprit, greed's silent role in recessions, the untold tale of market crashes and economic turmoil. Welcome to our eye-opening journey into the hidden truth behind all recessions. From historic bubbles to recent crashes, we'll expose the unspoken root cause, human greed. Join us as we explore how speculation, easy credit, and bubbles intertwine, leaving lasting impacts on real people's lives. Brace yourself for an engaging exploration of financial crisis and discover the vital lessons we must heed in 2023 and beyond. Don't miss this compelling insight into the world of finance and the critical importance of learning from our past mistakes. Let's dive in. The tulip bubble. Let's travel back to 1636 in Holland, where tulips were more than just flowers. They were symbols of luxury and status. The tulip market saw a surge in speculation, leading to a rapid increase in prices. As demand soared, tulip bulbs were even valued as high as houses. However, this market was built on false perceptions and hopes of quick riches, detached from any real economic growth or production. The tulip bubble is an essential historical example, emphasizing how speculation can create an unsustainable bubble unsupported by underlying economic realities. The eventual saturation of the market with tulips caused prices to plummet, leaving many people facing financial ruin. Today, we find similarities in recent speculative crazes like cryptocurrencies and NFTs, emphasizing the importance of learning from history and exercising caution in the face of price bubbles. Stock market crash of 1929. The roaring 1920s witnessed an economic boom in the United States, prompting an influx of investments into the stock market. However, a significant portion of this investment was fueled by low margin requirements and easy credit, leading to excessive speculation. Investors could buy stocks with as little as 10% investment capital, which created a dangerous leverage scenario. As stock prices skyrocketed, investors became increasingly optimistic, believing the upward trend would continue indefinitely. Unfortunately, the stock market crash of 1929 shattered these illusions. Within a few days, billions of dollars were lost, leading to widespread bankruptcies and a domino effect that sent the entire U.S. economy into the Great Depression. This historical event reveals how easily credit and speculation can create an unsustainable bubble, where market valuations become divorced from economic realities. The aftermath of the crash paved the way for financial regulation with the establishment of the Securities and Exchange Commission, SEC, in 1934, emphasizing the need for checks and balances to protect investors and prevent fraud. The dot-com bubble. The dot-com bubble, which took place in the late 1990s and early 2000, marked a period of frenzied speculative investments within the tech industry, divorcing from the actual economic landscape of the internet at that time. With the internet still in its infancy, there was a widespread belief that any online presence could guarantee astounding growth for companies. Consequently, investors poured funds into tech startups, even those lacking a proven business model or path to profitability. Consequently, many of these companies were given inflated valuations that bore no relation to their actual worth or future cash flow. The Nasdaq traded at significantly inflated prices, far beyond the real value of the dot-com companies. The bubble inevitably burst in 2000 when numerous companies failed to generate profits, exposing the absence of substance behind the hype. Many dot-com startups went bankrupt due to their high cash burn rate and inability to raise more capital. Even the most successful tech companies saw their stock prices plummet. This collapse had widespread ramifications, causing a substantial stock market decline and mass job losses as the economy reeled from the consequences of excess. The dot-com bubble teaches us the importance of focusing on profitability and sustainable growth in new businesses, rather than succumbing to speculative hype. This period of market correction eventually paved the way for more stable and profitable tech companies like Google, Facebook, and Amazon to emerge as market leaders. Financial crisis of 2008. Yet again, history unfurled the familiar tale of boom and bust as the echoes of the 2008 financial crisis reverberated. Greed, speculation, and reckless lending resurfaced as culprits behind the market crash, crippling both the stock and housing sectors and sending shockwaves through the broader economy. Irresponsible lending practices prevailed, with banks extending credit to individuals who sought homes beyond their means. These subprime mortgages were bundled into intricate financial products sold to investors, culminating in the collapse of the financial derivative system when borrowers defaulted on their loans. The 2008 crisis etched itself as one of the most catastrophic economic disasters in history, leaving a trail of devastation across the globe, profoundly impacting countless lives. The aftermath of the crisis still lingers even after more than a decade, its lingering effects continuing to be felt. Once more, the crisis owed much to easy credit and speculative practices. Loans were handed out to individuals with questionable repayment capacity, fueling a housing bubble that inevitably burst. In 2008, soaring home prices resulted from lax home loan regulations, mirroring the recent home price surge observed between 2018 and 2022. The far-reaching consequences of the global financial crisis included the collapse of major financial institutions and a prolonged global recession that endured for years. In the aftermath of the meltdown, fingers were pointed in search of culprits. Some pointed accusatory fingers at Wall Street and the banks, while others criticized government regulators for their failure to rein in the excesses of the financial system. The crisis was the culmination of multiple factors, such as easy credit availability, low interest rates, inflated central bank balance sheets, rampant speculation, and a lack of effective regulatory oversight. 2023 and beyond. In 2023, the world grapples with a host of new challenges, each carrying significant implications for our financial well-being. Inflation, a burgeoning housing bubble, impending financial crisis, and the unpredictable rise and fall of cryptocurrencies loom large, fostering feelings of overwhelm and powerlessness. Nonetheless, amidst this uncertainty, we must recognize that we possess the capacity to shape our financial destinies through informed decisions and a steadfast refusal to partake in speculative bubbles. Employing strategic investment approaches and trading systems that leverage a competitive edge will prove pivotal in safeguarding our economic interests. Although some may dismiss financial crises as cyclical inevitabilities, the undeniable truth lies in the real-world ramifications of imprudent monetary policies and bubbles devoid of genuine value. These far-reaching consequences significantly impact people's lives, underscoring the urgency to act responsibly and prudently in financial matters. Unveiling the root cause of recurrent recessions unveils an uncomfortable truth. Greed pervades all levels of the economic system. A relentless pursuit of maximum profit, coupled with a willingness to embrace risks, perpetuates a cycle of repeated mistakes. Innocent investors and ordinary individuals often bear the brunt of these reckless actions, having no direct involvement in the decisions leading to crisis. Drawing from historical lessons, we discern that financial turmoil emerges when greed supersedes sound financial principles. The onus falls on us to learn from these past errors and avoid exposing ourselves to the perils of speculative bubbles. By prioritizing responsible practices and informed choices, we can collectively steer towards a more stable and secure financial future. In conclusion, understanding the unspoken root cause of all recessions is crucial for preventing future economic disasters. By analyzing historical events such as the tulip bubble, the 1929 stock market crash, the dot-com bubble, and the 2008 financial crisis, we see how easy credit and speculation can lead to unsustainable market conditions. As we navigate the challenges of 2023 and beyond, we must prioritize sound financial practices over quick gains to ensure a more stable and prosperous future for all. Remember, it's not just part of the business cycle. It's our collective responsibility to learn from the past and make better choices moving forward.